Hello everyone, my name is Maria Thomas and I work for Allianz Research, a global team of economists, strategists, sector advisors and foresight experts of the Allianz Group, led by Ludovic Subin. Over the past few months, we've seen central banks in advanced economies raise interest rates for the first time in years to cope with record-breaking inflation. So in this special season of Tomorrow, we wanted to look at the end of zeronomics. What will the new era of higher interest rates mean for the global economy and capital markets, households and companies? Let's find out with the experts from Allianz Research. The US housing market is adjusting to the new reality of higher for longer interest rates. In this episode, we speak to Senior Economist Maxime Darmet to find out more about what's happening in housing and mortgage markets and what it means for the US economy. Hello, Maxime. Welcome to the podcast.
Hello, Maya.
So we're actually speaking at just the right moment, right? Because the Fed just raised interest rates again a few days ago. But before we look at what's going on with the housing market today, maybe you can explain for our listeners, how did years of low interest rates shape the US housing market up until now?
Yeah, sure. I think it's very important, first of all, to stress that it was a combination of, as you said, declining mortgage rates over the past 20 years. So the cost of mortgage have declined. But it's also the fact that credit availability has eased considerably, which means basically that banks have been able to provide more credit to households. And, like the combination of those two really ushered a booming housing market, which started in the early 2000s. Prior to that, we only had really one mini boom in the second half of the 1980s. But really, things started to change quite dramatically from the early 2000s, when the Fed became very loose in terms of monetary policy. So now, if you're asking me what pushed up house prices so much over the past 2 decades or so, I think there are really a couple of reasons for that. First of all, you got policymakers which incentivize home ownership. So it was policy driven in a sense. You had also, as I said, the Fed, which really targeted support for the housing market, including during the pandemic, by buying large amounts of bonds linked to the housing market, the so-called RMBS. And also during the pandemic, I think it's important to stress that you had very generous cash handouts provided by the federal government. So this boosted savings and it boosted deposits at the bank. And as you know, more deposits in banks ultimately means more credits. So it allowed banks to ramp up credit to households to buy new houses. And in this environment, you really had a booming demand for housing, but at the same time, and that is one of the issues, the new supply failed to keep up. And since the pandemic, we heard a lot about the widespread shortage of labor, equipment, and materials, and we really these things happening in the U.S. housing market, with really these supply shortages starting to bite against a backdrop of strong demand. So the result was really frenzy house prices. Just to give you a couple of numbers, in real terms, U.S. house prices grew on average 7% per year. Between 2000 and 2006, 4% between 2012 2019, and 9% since the pandemic. So it's really astonishing numbers we got here.
Okay. And so what's happening now that rates are starting to rise, or have already started to rise quite considerably?
Yeah, since end 2021, when the Fed started to become serious about inflation and starting to become aggressive, right, by raising rates very rapidly. Mortgage rates has been really hitting the roof. So they are now around 7% for a 30-year mortgage, which is really, really high for historical standards. It's really a reverse of a previous trend we've seen over the past 3 decades even so. The fallout on the US housing market has been really quick since the spring of 2022. And things actually accelerated during the summer. As you know, the housing market is really one if not the most interest rate sensitive sector in the economy. So it's not surprised that it's reacting very rapidly to the Fed tightening. Just to give you a couple of examples, housing affordability has really plummeted for prospective buyers. So it's been really, really difficult. When you ask also households plans to buy a new home, it also dropped. So very few households now want to buy a home, which makes sense, of course, because the cost of a mortgage is so high now. I think it's very interesting, the mortgage application index. So basically, now the number of people asking for a new mortgage or to refinance their existing mortgage is at its lowest in 23 years now. So really, really big shock. You can also see the impact on the housing market in terms of sales or starts, all dropping very rapidly, and so on. Finally, I would say like the last domino to fall is prices. Houses prices, as you know, it's typically the last domino to fall in a housing cycle. They're more lagging, and we've seen June actually. So over the past couple of months, actually starting to come down from a peak reached in May, and now they are approximately down 2.5% in real term. So things have really started to turn down.
Okay. Can you tell us maybe a little bit more about what you expect to happen next?
Yeah, so I think there are two things to look. So first of all, when you look on transaction and construction sides, so sort of the real economy, it's very clear that further sharp declines are in the cards. For instance, when you look at Home Builder Sentiment Index, which is a pretty good leading indicators, it's down very sharply, and it suggests that housing starts could come down by about 25% in the next couple of months. So huge turnaround, very massive. Second, they ball on prices, the outlook on prices. We talked a lot about it in the report. There's a couple of instruments or data we look at to predict prices, but I think the main one is really looking at deposits in banks and financial institutions, because deposits, tend to be a really good lead proxy for mortgage credits in the next 12 months. And if you look at this kind of indicators, it suggests that first of all, mortgage credits are going to come down quite heavily. So banks and financial institutions are going to pull back from the business of doing mortgages. And based on all of this, we expect house prices in the US to fall by approximately 10 to 15% in the next 12 months. So a pretty sharp correction, I would say.
And so what does that mean for the US economy overall?
Yeah, so, the housing market is really a key, if not the key driver of the US business cycle. So it's really something we have to look at very closely. And so we are, as I said, we are quite downbeat on the outlook for the next 12 months. And this is one of the reasons why we expect the US economy to slip into a recession very soon. We are amongst the most downbeat in the consensus. We expect the US economy to contract by approximately 0.7% next year. So first of all, when you look at residential investment, is already dragging down the economy. So it should be down approximately 10% this year. We expect minus 13% next year. So all else equal, that would knock about 0.4 percentage point of GDP growth. So sizable amounts, but this is not the main channel through which the housing market impacts growth. The main channel, as we highlight in the report, is through the prices, house prices. So again, very important. House prices, they affect the economy mostly through the so-called wealth effect, because when people, they see the value of their home coming down, they feel less rich, less wealthy. So they tend to curtail consumption and investment and so on. It's a very, very powerful channel in the US. So we run a bit of an estimation, and we estimate that house prices in the past, they boosted GDP by nearly one percentage point in the early 2000s and nearly 2 percentage points in the post-pandemic. So it's a really, really sizable effect. But now we're seeing prices declining by 10 to 15% in the next 12 months, as I was explaining. And we will expect that would knock up to 1.72 percentage points of GDP by early 2024. So really, really, really large amount, a sizable drag to expect over the next couple of quarters. So that's why we expect a recession, really, US recession coming mostly through this channel. Now, just a few words on maybe some good news. I would say we expect the blow, however, to be maybe lower than it used to be. And to be clear, we're not expecting any housing crash or financial crisis, like really not something like in 2007 and 2008. Debt relative to income is much lower, first of all. And also the vast majority of mortgages which have been taken out in the past are on fixed rates. So these households are less likely to be impacted by rising interest rates. And finally, banks have healthier balance sheets than in the past, so they're less likely to be adversely impacted by the housing market downturn.
All right. Well, thank you very much, Maxime.
Thank you, Maya.
Thank you so much for listening. You can find the full report we just spoke about on our website. We'll leave a link in the show notes. If you'd like to discover more of our research, you can also follow the Ludonomics newsletter on LinkedIn. We'll leave a link down below for that too. If you like the podcast, please send it to any of your friends who might like it too, and leave us a rating and a review. We'd love to hear your feedback. In the meantime, stay tuned for the next episode.